Okay, here's my thesis in a nutshell. Little by little, the name of my show, well, little by little, all of a sudden, stablecoins are everywhere. Where the hell were they 2 years ago? No one knew stablecoins. Trump was saying, Jamie Dimon was saying that crypto's a scam. And why would and now all of a sudden, bam, right in your face, little by little, and all at once, stablecoins are everywhere. You're going to see corporations around the globe issuing stablecoins. JP Morgan just announced a partnership with Coinbase, and they're going to allow the bank accounts to link with your crypto account, and you can trade your Chase points that you got for using your credit card into stable coins right through Coinbase, which will be linked one-to-one or real damn close to it to U.S. treasuries. The issuance of all of these stable coins and saying it's much easier and much quicker and blah, 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 okay, that's true. But I believe that Besant, who said we're going to go very big on stable coins, up to $2 trillion a year, will be used to load the front end of the yield curve, up to 2-year duration in treasury, low rates. But the constant use of these stable coins will do just that. Now, what happens to the back end? The back end, to me, will be backed by gold. Now, Judy Shelton said to me on my show with her, and she's been saying it again lately, that July 4th next year, 2026, is a big day for Trump, a huge day, and it's the 250th anniversary of the country. And she said, Andy, he will issue gold-backed treasuries at that point, redeemable in gold. And I said, Judy, do you think gold will be revalued? It's held in the gold revaluation account, and not in so many words. She said, yes. Now, when we're done with this, I want to get your opinion on what you think about gold revaluation, but James Rickards comes up with a number of near 24,000. He does that by dividing the money supply into the gold. And well, if that happened, I'm just saying if it did, that would give the Treasury General Account about $6 trillion free and clear, as every $4,000 increase would give the Treasury $1 trillion. Every $4,000 increase gives the Treasury $1 trillion free and clear. They would issue those certificates to the Fed, who would print the money out of thin air and give the money to the Treasury. Now, the certificates and the gold that they hold only gives credit or claim on the dollar value of the gold, not the gold itself. That belongs to the American people. So it's an accounting gimmick. But the printing of all of that money, in James' case, would devalue the dollar by over 60%. So you destroy the value of the dollar. You're purposely doing it. How do you pay $28 trillion in come-due treasuries with $15 trillion in revenue? You don't. You destroy the value of the dollar. You inflate the out of it. And you devalue the dollar. Now, he wants a weak dollar. We've seen it fall already, but why? Because he wants to bring back manufacturing. So if you destroy the value of the dollar, you devalue the hell out of it, you push gold way up and back it to the Treasury, as Judy says will happen next year, July 4th. Who knows if she's right or not? I think she is. So you got the stable coins running the front end of the market, $2 trillion a year running the government spending. Back end of the market is pegged to gold at zero coupon, zero interest rate bonds, redeemable in gold at a much higher price, because the more stupid we are with fiscal and monetary policy, the higher the price of gold goes. That is your inflation hedge. So you have zero borrowing costs on the back end, a massively devalued dollar because they revalue gold, which is held in the gold revaluation account. Everyone's talking about it all of a sudden. I've been talking about it for over a year now that they're going to do this. And so you devalue the dollar, you have a zero borrowing costs on the back end. Now you can bring back your manufacturing at zero borrowing costs and a devalued dollar, which helps you sell your goods across the globe in a very competitive manner. In essence, soft defaulting on the U.S. dollar reserve standard in an effort to bring demand into the U.S. Treasury that is trustless. It's backed by gold, redeemable in gold. And Judy said they'll issue stable coins off of those too. So now you got all these stable coins funding the government, the back end of the bond market, zero interest rates, so that you can bring back manufacturing and have a noble attempt at growing our way out of a problem where we have zero shot in hell otherwise. As my mentor, Richard Russell, used to say, the Fed 20 years ago was trapped they would inflate or default. How about this? I'll have zero borrowing costs to bring all your manufacturing back, a devalued dollar, no reserve standard, but still the supreme power in the world, because we now can grow our way organically out of this problem over time and put people to work and give future generations hope and optimism. Because as it is now, if we don't make anything, and a lot of the low-paying white-collar jobs are gone. You know, my son works for me now, but he was a CPA at Price Waterhouse, earning $75,000 a year, analyzing balance sheets for real estate investment trusts. What the hell does Price Waterhouse need to pay that kid $80 grand to realize to analyze a balance sheet when GPT or any AI, bang, it's done. And so these kinds of jobs are gone. So you need to bring manufacturing back, not only to put people to work, but for the own national security, pharmaceuticals, aircraft parts, microchips, all this stuff. And now you actually have a shot at it.
Let me start by asking you something. Did you even know what a stablecoin was 2 years ago? Be honest. Outside of a handful of crypto diehards on Twitter, no one was talking about them. Back then, Trump was calling crypto a scam. Jamie Dimon was waving his finger at Bitcoin saying it would blow up. And your average investor figured stablecoins were just some weird digital token that had no use. Fast forward to now and suddenly they're everywhere. JP Morgan is partnering with Coinbase. Chase is linking its bank accounts directly to crypto wallets. And you can even swap your Chase credit card reward points into stablecoins that are pegged one-to-one to US treasuries. Nobody voted for this, nobody demanded it, and yet here it is, little by little, then all at once. That's the story of our financial system, folks. Things are hidden from sight, ignored for years, and then suddenly they're dropped on you like they've been there all along. So let's be very clear. Stablecoins aren't some cool new innovation for the everyday person. They are a lifeline for a desperate government that can't fund itself honestly anymore. Behind all the marketing about faster payments and safer rails, what you're really looking at is trillions of dollars of new demand for short-term US treasuries. Every stablecoin that gets issued has to be backed by something, and that something isn't gold or hard assets, it's government IOUs. And this is not a coincidence. The Treasury has $28 trillion in maturing debt over the next 3 years. And on top of that, we're running deficits north of $3 trillion a year. They're talking openly about printing $1 trillion per quarter just to keep the lights on. Who's going to buy all that debt? Not China, not Japan, not Saudi Arabia. They've all been net sellers of treasuries. Instead, the Cayman Islands and Ireland suddenly show up in the data as the new buyers. Folks, that's not legitimate demand. That's a shell game. So how do you solve this? You invent a new buyer, and that's what stablecoins are. A backdoor way to manufacture artificial demand for treasuries. This is why Janet Yellen has been front-loading issuance into short-term bills. 1 month, 3 month, 6 month maturities are cheaper for the government than issuing 30-year paper at 5%. But even those short-term bills need buyers, and this is where stablecoins come in. By pushing every crypto exchange, every fintech platform, and even the biggest banks into the stablecoin business, you create trillions in natural demand for government debt that would otherwise struggle to find a home. As Luke Gromen has put it, stablecoins are being used to anesthetize the front end of the yield curve, keep short-term rates artificially suppressed by forcing demand into that space. That buys time, but it doesn't solve the bigger problem. It's like paying off one maxed-out credit card with another. Eventually, the whole structure comes down. Now let's talk about the dollar, because the only way out of this debt trap is to devalue it. Trump himself has said it openly. He wants a weaker dollar to bring back manufacturing and make U.S. exports more competitive. A weaker dollar is inflationary for you and me. It means higher prices at the grocery store, at the gas pump, everywhere. But it's the only politically acceptable way to shrink the debt burden. And make no mistake, this isn't happening by accident. It's deliberate. You cannot pay off $37 trillion in debt over the next 3 years with just $15 trillion in tax revenue. It's mathematically impossible. So you inflate it away. You destroy the value of the dollar on purpose while telling the public that stable coins and digital rails are progress. And of course, the circus around it is nonstop. Just this week, I saw a tweet with 10,000 likes saying, "Stablecoins will save the global financial system. No need for gold anymore." Imagine cheering for a system that ties your future to the most indebted government in world history. Another tweet nailed it better. JP Morgan, you'll own stablecoins, you'll love stablecoins, and you'll never ask what's inside them. That's closer to reality, and yet the politicians and the media will keep selling this as modernization, as a way to bring efficiency to payments. What they won't tell you is that you're subsidizing government debt every time you touch one of these so-called innovations.
When you look at the BRICS talking about a gold-backed system, the expansion of the Shanghai Metals Exchange, how important gold is. They said last year they agreed in principle to a settlement currency called the unit, which was 40% gold backed and redeemable. They're going to do it. I think someone told Trump, we need to do it, because since November, the amount of gold coming into this country is off the charts. I mean, really off the charts. I don't know if you noticed, but just the first 3 days of this August contract, 20,126 contracts stood for delivery.
Yeah.
100% of all the contracts that were posted have stood for delivery. Now, I know you remember most of your career, most of my career, less than 1% of contracts stood for delivery. And now 100% of them have stood for delivery in the first 3 days. That's $7 billion worth of gold standing for delivery. And a lot of it's leaving the ecosystem. It's loading out of COMEX. Over $100 billion in gold has come in since November that we know of through the COMEX. Who the hell's buying it all? Why don't we know more about it? So if Judy is right, you would have to reshore your gold, get it all here, and then revalue it, and then peg it to the treasury. And while the stablecoin bill takes care of the funding on the front end of the curve, the back end peg to gold, 0 interest rates, redeemable in gold, bring back your manufacturing, and look the world in the face, or look the United States in the face. And Trump says, look, we squandered this opportunity. It used to be great, but now it's harming us. We have no manufacturing. We need to get it back. Here's how we do it. It's going to be tough for a while. You're going to need to crawl through the tunnel of the way that Andy Dufresne in the Shawshank Redemption did, to get to the other side. And that other side is we now are the epicenter of ingenuity and innovation and manufacturing like we once were. Because as it is now, we're in trouble if we don't. That's my theory. Think about it. But one of the things that I found very interesting, to your point about what the BRICS are doing, Andrew, and I haven't heard a lot of people say this, is that, so they came out, China did. Now, first, the key to all this is building all these multi-jurisdictional vaults. Ask Venezuela about that. When their gold was held in the Bank of England, no, we're not going to give it to you. So now you have vaults all over the place where each country will sprinkle gold amongst these vaults, in theory, to spread out the jurisdictional risk. But one of the things that's interesting to me is China came out about a month ago, Andrew, and said, we have connected our bridge platform, which is in essence MBridge, to the 11 Asian countries, ASEAN, the countries in Southeast Asia. They're operational, and 5 Middle Eastern countries. Now, this represents 38% of global GDP, saying they've connected the bridge network to 38% of global GDP. It's operational. It's working. These Asian countries. And what's really, really interesting is the article that just came out of Forbes. And let me just read this to you. It says, Forbes pointed out that China is now just the 3rd largest trade partner for the United States, and a distant 3rd behind Mexico and Canada. In the month of May, China was less than 6% of U.S. trade, which was the lowest level in over 20 years. Then you have the Asian countries, ASEAN. Again, these are the countries Southeast Asia. And together, they have a population over twice as large as the United States, nearing 800 million people. These are also some of the fastest growing consumer markets in the world, with a fast growing middle class. And this group of countries, wait for it, is now China's largest trading partner by far, way ahead of the European Union and the United States. We did 6% of trading with China. They're doing almost 20%. And they're their largest trading partner. These countries in Southeast Asia are now connected to the MBridge and settle imbalances in gold.
Now let's push this conversation into the future, because stablecoins are just the appetizer. The real main course comes with the revaluation of gold. Judy Shelton said it to me straight, and she's been repeating it more often. July 4th, 2026, America's 250th birthday, will be the day Trump unveils gold-backed treasuries. I don't think she's just speculating. She was Trump's nominee for the Fed in 2016. She wrote the book on gold-linked money, and she's been in the rooms where these ideas are discussed. Think about the symbolism here. The country turns 250, and the government tells the world, the dollar may be broken, but U.S. treasuries will now be redeemable in gold. It's not just monetary policy, it's theater. And trust me, politicians understand theater better than anyone. So how would it actually work? It's not as complicated as they'd like you to think. Gold is already held on the Fed and Treasury's balance sheets, but it sits there at the laughable price of $42.22 per ounce, a relic of the Bretton Woods system. All they have to do is revalue it with a stroke of the pen. Say the Treasury declares gold is worth $8,000 or $12,000 or even $24,000 like Jim Rickards calculates. For every $4,000 increase in the official gold price, the Treasury instantly books $1 trillion into its general account. No congressional approval required, no debate, just an accounting gimmick. But here's the kicker. The gold itself doesn't move. The Fed doesn't own the gold. The Treasury does. The Fed only holds certificates against its dollar value. So the Treasury can effectively print trillions free and clear, backed by revalued gold, without technically adding to the debt. That's how you pay down $37 trillion in maturing treasuries, when you only collect $15 trillion in tax revenue. You don't pay it honestly. You inflate it away. You devalue the dollar deliberately while telling the public you've strengthened the balance sheet. And if you think this is far-fetched, remember Roosevelt in 1933. He confiscated gold from the public at $20.67 an ounce, revalued it to $35, and instantly gave the government a 69% windfall. That's how they recapitalized the system in the Great Depression. Different crisis, same trick. Fast forward to 2026, and a similar move, except now they won't confiscate. They'll let the public keep their gold, but they'll revalue it so high that it resets the whole system. In fact, if you don't already own gold when this happens, good luck buying any. It will go bid only, which is trader talk for no offers, just buyers. You'll see a comic screen with nothing but empty quotes, while the physical market goes black. Now ask yourself this. Why have central banks been buying more gold in the last 2 years than at any time since the 1950s? Why has China been hoarding through the Shanghai Gold Exchange, setting up vaults in Hong Kong and Saudi Arabia? Why has Russia doubled down on gold after being sanctioned? They know what's coming. They're positioning for a post-dollar world where trade is settled not in IOUs, but in something real. China doesn't want the yuan to collapse alongside the dollar, so it will use gold to anchor its credibility. Russia could go gold back tomorrow if it wanted to. The US doesn't have the luxury of waiting much longer either. This is a global chessboard, and the pieces are moving fast. But let's not forget the insiders here at home. Since November, we've become net importers of gold for the first time in 35 years. Do you think that's a coincidence? That's when Trump won the election. Since then, we've seen massive inflows into COMEX, draining the LBMA month after month. Jeff Bezos sells $5.7 billion in Amazon stock. Zuckerberg dumps shares. Nvidia insiders cash out hundreds of millions. And where's that money going? Into physical commodities, into gold, into silver. Over $100 billion worth of precious metals taken off exchanges this year alone. That's not retail investors. That's not stackers. That's the biggest money in the world taking delivery, while the public is all in on equities at record exposure. Folks, this is the setup for the greatest wealth transfer of our lifetimes. Insiders are running for the exits, and the public is rushing into the theater for the last act of the play. What could possibly go wrong? And here's where I'll inject a little humor, because sometimes the truth is too heavy without it. The US government reminds me of the guy at the casino who keeps doubling down at the blackjack table. He's out of chips, he's sweating, and he pawns his watch just to stay in the game. And the crowd around him cheers. He's going to win it back. Spoiler alert, he doesn't. That's America's fiscal policy in 2025. Except instead of pawning a Rolex, they're pawning the credibility of the US dollar. And when they finally lose, the dealer will say, "Sorry, pal, house always wins." In this case, the house is gold. So let's look at what happens after the revaluation. If gold is revalued to $24,000, as Rickards suggests, the dollar loses 60% of its value overnight. Inflation rips higher. Imports become insanely expensive. But exports suddenly look competitive. With a devalued dollar and zero interest on long-term treasuries redeemable in gold, Trump can stand in front of the American people and declare, "We're bringing back manufacturing. We're putting Americans back to work." That's the political sales pitch. And it might actually work for a while. Pharmaceuticals, aircraft parts, semiconductors, all the critical supply chains we foolishly outsourced, could be reshored under a cheap dollar regime. But make no mistake, this is a soft default. The US will never pay its debt honestly. It will inflate, revalue, and paper it over with gold. That's the only way out. Now here's where investors need to wake up. If you save in dollars, you're destined to go broke. Period. That's not hyperbole, that's the math. You cannot save in a currency that is being deliberately destroyed. If you're not contrarian right now, you're not going to make it. The public is always late. They always pile in after the insiders are done. You don't want to be the guy buying gold at $15,000 when the system resets. You want to be the guy holding it before the curtain drops. And don't just think in terms of price, think in terms of value. How many barrels of oil can you buy with an ounce of gold? How many bushels of wheat? How much of the Dow Jones? That's the real measure. Gold isn't about price, it's about purchasing power across cycles. And before anyone asks, yes, I expect they'll issue stablecoins off these gold-backed treasuries as well. Imagine that. A gold-backed stablecoin redeemable in treasuries that are themselves redeemable in gold. The marketing writes itself. They'll tell you it's the safest instrument on earth, and the public will believe it. But understand what's really happening. The system is being reset, and you're being herded into a new digital corral. The insiders will already be holding the real thing. You'll be given a token that says backed by gold, while the actual gold sits in vaults far away from your reach. So let me leave you with this thought experiment. It's July 4th, 2026. Trump stands at a podium draped in American flags. Fireworks are going off. He declares that US treasuries are now redeemable in gold. The media calls it historic. Markets go wild. Gold spikes, the dollar collapses, and the public scrambles to buy what little is left. In that moment, you'll either be one of the people watching your purchasing power evaporate, or one of the people who saw it coming and positioned accordingly. Which side do you want to be on?
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.